The chapter that we are seeing is debt market. The introduction is what is a debt instrument. Now, if you read, debt in its simplest form is nothing but a loan given by a person to another who promises to repay the same at a given date. More importantly, agrees to pay an interest. One of the methods used by government, by companies is through debt. So, what is a debt? Very simply, debt is nothing but a loan. Okay, you call it a loan. Some people call it a debt, which means that if you borrow money from someone and you have to repay that money to that person, it is called as a debt. You are in debt to that person. Okay, so the same principle is used by corporates. Okay, when a company wants to raise money, when a company wants to raise funds, one of the options that it has is to take a loan. Now it can take that loan from either a bank. The another option that is exercised by companies is not to go to the bank to get a loan, but also to go to the general public and get a loan from the public as such. In the same way you issue shares to public. What do you do when you issue shares? You come out with a public issue and ask people to subscribe to the shares of your company. They become the owners of your company, shareholders. In the same way, you go to the public with the offer document and ask them to give you a loan. They become creditors of your company. Okay, it is called as a debt. And then you issue, instead of issuing a share certificate, you issue them a debenture certificate. It is called as a debt certificate or a debenture certificate. What is a debenture? It's basically a loan. It's basically a debt which is acknowledged by the company by means of a certificate. Okay, what a certificate says that I'll pay you a fixed rate of interest, and at the end of the maturity period, I will repay your loan back. Once you understand what is debt and you are issued debt to the investors or the people at large or the public at large, just like shares, as I said, we are comparing shares and debt, right? So when you issue shares to the public, what is the main advantage in a share? It is tradable. When I subscribe to the shares of a company, when I purchase shares in a company, after I purchase them, I don't have to keep it with me forever. Till the time want to, I can keep it. After that, I can sell it to whoever is ready to purchase those shares. So the same thing should also be available for debt. Otherwise, investors won't be interested. So the option has to be given to the investors to also sell their debt to some other person who is willing to take over the debt. So that helps create a market for that debt instrument, and that is called as a debt market. A market where you can buy and sell debentures or bonds as they are called. See, these terms are used interchangeably. Debentures, bonds, debt, loan, it all means basically the same thing. It's nothing but a loan. So a market where you can buy and sell debt securities is called as a debt market. So debt market in India comprises mainly of two segments. One is the government securities market, which consists of state and central government securities, and the corporate securities market, which consists of financial institution bonds, PSU bonds, debentures, corporate bonds. The trading of government securities is currently through negotiated dealing system on the BSE NSE. Bulk of corporate bonds being privately placed were however not listed on the stock exchange. So basically the debt market in India is covered into two parts: government debt and private debt. Government debt means the debt instruments which are issued by government. Government also from time to time borrows loans from it. The government borrows a lot from the public in general, from you and me and other people in the country. The other side of the debt market, which is what we are talking in this chapter, is the private debt market. It's basically the debt instrument issued by the private body corporates such as companies, which are traded, and they are traded on the BSE and all the NSE through what is called the negotiated dealing system. Okay, so it is issued in electronic form and you can trade also it in electronic form. So then what are the various types of debt instruments? First is the corporate debenture. So what is a debenture? Debenture is a debt issued by a company. Essentially it's a loan taken from an investor. And what do you agree? You agree that I will pay you interest at fixed intervals. Now that intervals can be 6 months or 1 year or 3 months, what depending on what that instrument is. And at the end of the maturity period, I will return your principal. Okay, so the investor gets a dual benefit. In any debt instrument, it gets a dual benefit. The principal is secured. At the same time, I am also earning interest on the money that I am putting in. Okay, which is not the case in case of equity shares. Equity shares, you get a dividend if the company performs well. The dividend in equity share is not compulsory, right? The company may declare dividend, it may not declare dividend. That is up to the company to decide. In case of debt instruments, they have to pay you interest at whatever time they have agreed to. So that is a fixed income. Plus your principal is secured. In case of equity share, if you buy a share at 100 rupees today, when you go to sell it, it may be 1000 rupees or it also may be 10 rupees. But in case of debt instrument, the principal is secured. So it's basically a safe investment. Anybody who wants to make a safe investment will take a debt instrument. The people who generally take debt instruments are people who are interested in fixed income. They are not interested in higher returns. They are interested in having a regular return at the end of every month. So debentures can be divided into two different categories on the basis of convertibility of the instrument and security. So debentures are divided into two parts, convertibility and security. So what do you mean by convertibility and security? Those debentures which are secured and unsecured. They are further divided into secured debentures and unsecured debentures. Or convertibility means either they are convertible or they are non-convertible. Convertible means they will be convertible either into equity shares or into some other instrument. Or they are not convertible, they remain debentures and they will get repaid. When you say in security, what does it mean? One, it will be secured. Two, it will be unsecured. Secured means there will be a security created for the purpose of this debenture. Unsecured means there will be no security created. What are the other fixed income products? As a medium of saving and as a means of payment and a very important variable. Bank has three types of deposits: time, saving and current account. Then there is a fixed deposit, are sums acceptable by most NBFCs and banks. Interest rate that may be offered is regulated. So these are the various fixed income products. Either it's a fixed deposit or it's a saving account or it's a current account. They put your money and you get a fixed rate of return. Okay. Then there is something called as the interest based bonds. What is mean interest based bond? One is the coupon bonds. Coupon bonds typically pay interest periodically at the pre-specified rate of interest. The annual rate at which interest is paid is known as a coupon rate or simply coupon. Interest is usually paid half yearly through, in some cases it may be monthly, quarterly, or there may be zero coupon bonds. A plain bond is offered at its face value, stream of interest till redemption is redeemed with or without a premium or a maturity. What is a zero coupon bond? They might ask you this question, what is a zero coupon bond? See, either you issue a bond which has a regular interest, which is a coupon bond, like every half year, 6 months, 8 or 1 year or 3 months, the interest will be paid, and it is called as a coupon rate, and it is called the date on which you pay the interest is called as a coupon due date. The other way around is you issue a zero coupon bond. What do you mean zero coupon bond is there is no interest. So if I issue a debenture today and ask you to pay 100 rupees for it, what I will say is that you will not get any interest during the tenure, but at the time of redemption, whatever interest is accumulated during that tenure will be added back. Say if it is for 3 years and in 3 years you are going to have say 30 rupees as an interest. So I will not give you 10 rupees each year. I will give you all 30 at the time of redemption. So you will get 130 back. Or the other way around is it's 30 rupees and 100 rupees. So you pay, instead of paying you 130 at the end of the 3 years, what I will do is right now for a 100 rupee debenture, I will ask you to pay 70 rupees. I will issue it at a discount, and then at the time of redemption, I will give you 100. It is one and the same. So it is called as a zero coupon bond. And finally, it is derived instruments that include securitized debts or mortgage bonds or any derivative instruments. See, these are the various type of debt instruments. Mortgage bonds. As I said earlier, debentures are categorized as secured and unsecured. Now, what is a secured debenture? It is also called as a mortgage-backed bonds. It is also called as a collateralized debt offering. What it basically means is, I'll tell you in very simple terms so that you remember it and you can write it in your exam. When you issue a debenture, when you issue a bond, what is the guarantee that the company will pay? If you tell the investor that I will pay you interest and I will pay you your principal back in 3 years, what is the guarantee that you will pay? What if you say I will not pay? What is the protection that he has? So in order to have a protection, there is something which is called as a security. You create a security in his favor. What it basically means is you take some property, either movable property or immovable property, and you pledge that property or you mortgage that property or you hypothecate that property depending on what property it is. When you do that, you mortgage or hypothecate that property in his favor. So what it does is, if you do not pay his money back, if you do not redeem the debentures, if you do not pay the interest, if you default basically on your payment, he can sell that property and get his money back. If you when you take a housing loan, what the bank does, the loan that you take, you purchase a house, that house which you purchase and you live in is the security. It is a secured loan, it is a collateralized debt. What it means is that if you don't pay your EMI, the bank will come and take your house and then they will get their money back. That is the security. Okay, so that is called as a mortgage bonds. Pass-through certificates is when mortgages are pooled together and undivided interest in the pool are sold. Pass-through securities are created. Pass-through securities promise that the cash flow from the underlying mortgages would be passed through to the holders of the security in the form of monthly payments. So what it is basically is you pool certain mortgages that you have with you, and the interest in those mortgages is sold to some third party. It is nothing but a securitization, and I will tell you what a securitization is later in this chapter, so then you will understand what a pass-through certificate is. Right now, just you remember, it is nothing but a securitization where you securitize basically the interest. You don't securitize the instrument as such, you securitize the interest. I'll tell you what securitization is, then you will understand pass-through certificate better. Participation certificates are not very important. They are interbank instruments confined to scheduled commercial banks. The interest on such participation certificates is determined by two contracting banks. So this is not very important for your academic thing. Now, what is benchmark instruments? There are certain debt instruments wherein the fixed income is earned based on a benchmark. For instance, the floating interest rate bonds are benchmarked to LIBOR or MIBOR. There are certain instruments where normally the company specifies what is the rate of interest. It is 3, 4, 5, 6%, whatever. In some cases, and this is typically true in case of very short term borrowings, it's when you want to borrow for 1 year or 2 years, what they say that they don't specify a rate. They say it is either LIBOR or MIBOR plus something. What is LIBOR and MIBOR? LIBOR is London Interbank Offer Rate, the full form of LIBOR, and MIBOR is Mumbai Interbank Offer Rate. So what it means is, banks, when they borrow from each other, in the money market, there is a standard money market for banks to borrow from each other. The money market is very active for banks. Banks routinely borrow from each other to meet their fund requirements. Now, since the activities are too large, there is a well-developed market there, and RBI and central banks, they prescribes a standard rate at which the bank can borrow from each other. That is specified by the RBI. Okay, and in case of London, the market specifies a rate that if two banks want to borrow from each other, this is the rate, this is the minimum rate which they have to pay to each other. So that is interbank offer rate, and that is specified, and it changes, okay, with every day and every week the rate is revised. So then what companies do in very short term borrowings, they specify LIBOR or MIBOR. If we don't want to specify the interest rate, whatever is the interbank offer rate, we'll pay you at that rate or plus something. Floating rate means the rate is not fixed. As I said, floating rate of interest means that the rate is variable. Periodically, the interest rate payable for the next period is set with reference to benchmark market rate agreed upon by both the borrower. So floating rate is nothing but MIBOR or LIBOR is an example of floating rate where you don't specify any rate. It's not a fixed rate. It depends on whatever rate is fixed by others. Like you, again, as I said, like you have in housing loan. In housing loan you have a option of having a fixed rate or a floating rate. Floating rate means if the RBI changes the interest rates, your home loan EMI changes or in positive or negative. Fixed rate is you have a rate which is fixed at the time you take a loan. Now after that, even if the RBI decreases the interest rate, you are not benefited. Inflation linked bonds, a bond is considered index for inflation if the payments on the instrument are indexed by reference to the change in the value of general price or wage index. So then what it means is you link it to the inflation. The government will publish the wholesale price index or the retail price index or the inflation rate. So as the inflation rises, the rate of interest that is given to you also rises proportionate to the inflation. So it is linked to the inflation. Okay, that is why it is called as the inflation linked bonds. Now, what are debt market participants? Now, there are primary dealers. What are primary dealers? Primary dealers are important intermediaries in the government securities market. They act as underwriters in primary market and as market makers in the secondary market. Primary dealers underwrite a portion of the issue of government security that is floated. The underwriting commission of each primary dealer is broadly decided on the basis of its size and terms of its net owned funds. So primary dealers are nothing but market intermediaries. We have seen the chapter market intermediaries. One of the intermediary that we have seen are underwriters. So these are basically underwriters in the respect of government securities and market makers in case of secondary market. But their main role as a primary dealer is in the government securities market, where the government wants to issue a debt security. They act as underwriters. Now, what do you mean by underwriters is, if the government comes out with a debt security issue and they do not get a certain level of interest, or do not get a certain level of applications or subscription, then the remaining part of that, whatever is falling short, these guys take it. They undertake that if you fall short by so and so amount, we'll take the whatever you are falling short by, and for that you charge a commission. Then the brokers play an important role in secondary market by bringing together counterparties, negotiating terms. Brokers are, as I said, the same way there is a share broker, there is also as a debt broker. So if you want to buy or sell any instrument, even a debt instrument on the secondary market, you need a broker. You cannot do it yourself. You have to do it through a broker. Now, the second and the important thing is regulatory framework. Okay, the first part is role of RBI, role of SEBI. RBI is primarily concerned with government securities, so it is not very important for this chapter. But for debt markets, this debt market chapter primarily deals with debt of private body corporates and public companies. It does not deal with government debt as such. We'll just have a glance at the RBI role. The RBI manages the public debt, issues new loans on behalf of the union and state governments. It controls the issuance of new banking license. So RBI doesn't directly control your debt market of the government or the private companies. It does not control it directly, but it controls it indirectly. How does it control it indirectly? Public debt obviously is managed by RBI because it is a central banker. So any public debt or any new issues by the government, okay, that is done by RBI. As far as the companies is concerned, what it does is it prescribes interest rates. The CRR or the SLR or the base interest rate, that is prescribed by the RBI. The banking licenses are given by the RBI. The banks who actually give out loans, they are controlled by the RBI. So in that way, it indirectly influences the debt market. It indirectly influences everything actually. CRR SLR will come to that in later. I'll just tell you the full form, that is cash reserve ratio and statutory liquidity ratio. What it essentially means is the RBI prescribes the rate or the amount of money that the bank can actually lend. Just to give you a simple example, cash reserve ratio, that if you put 100 rupees in a bank in a saving account, the bank cannot lend that entire 100 rupees as a loan. What RBI says is that you have to keep certain amount of money aside and prescribes that rate, 5%, 10%, 15%, whatever that rate is. So if just assume that it is 10%, then if you get 100 rupees from a bank to a, say a person opens an account in the bank and deposits 100 rupees, out of that 10 rupees you have to keep with you, the remaining 90 you can lend, but 10 rupees is always with you. That is a CRR. And there is also something called the SLR, the statutory liquidity ratio. It's a ratio, it's your liquidity ratio. What is the amount of loans that you have given and what is the amount of loans that you have taken? The ratio between that. That also RBI will prescribe. So depending on all these ratios, the bank will have an idea as to how much money it can actually lend to the public or to the companies. So the third regulation is SEBI ICDR regulations. issue and listing of non-convertible debt securities, whether issued to public or privately, are required to be made in accordance with the provisions of SEBI issue and listing of debt regulations 2008. I think the title is wrong. SEBI ICDR is not the title. It should be SEBI issue and listing of debt securities. Okay. Now, this is the main guidelines which SEBI has prescribed for issue and listing of debt instruments. Okay. What it essentially says is, and I have given you the salient features of the guidelines. If you see the full guidelines and if you see your module, it is given in much more detail. So what are the salient features? The first thing that SEBI has done is it has issued the concept of credit rating. Now we have seen what is a credit rating in the chapter credit rating agencies and what are credit rating and how it is issued. What SEBI has prescribed is if you are coming out with any issue of debt, either it is public or it is private, you have to get it rated, and the rating has to be from two separate credit rating agencies. And in the issue document, whatever document you put out for the public issue of that or even for the private issue, you have to mention that credit rating. The second is appointment of debenture trustee. This is specified by the RBI and also by the Companies Act section 71 that in any debenture issue you have to have a debenture trustee. Now what is a debenture trustee? A debenture trustee is a trust that is created. The trustee is a person who is appointed by the bondholders or the debenture holders or by the company. It's typically appointed by the company, but he is a person who is appointed to protect the interest of the debenture holders. Now the concept is if you have say 500 or 1000 or 10,000 bondholders who are located in the various different parts of the country or the world, if it's possible, then for them to come together and take action against the company is very difficult, or their investment may be so small that it is not possible for them to fight the company. Okay, it is very difficult to communicate with them, it is difficult to coordinate with them. So for all these purposes you appoint one single point of contact which will protect their interest. What we mean by protect their interest is in the case that the company defaults on its payment, the trustee will have the right to sell the property. If any property is created as a security, the trustee will have the right to attach that property, to sell that property, to realize the proceeds from their property and distribute it among the bondholders or the debenture holders, whatever you want to use. So that is his basic role. His basic role is to take that property which is created as a security in his possession. And apart from that, he generally has to monitor whether the company is regular in its payment, is there in a possible chance of default. He has to do various administrative services for the bondholders. But it is compulsory that you have to appoint a debenture trustee. Okay. The third thing which is compulsory is debenture redemption reserve. Now what debenture redemption reserve basically means is the day you issue a debenture, you have to open a separate account in your books, the company's books, that is, the company has to have a separate account. You have to create a separate reserve in your books called as a debenture redemption reserve. Every year, you have to put aside a certain amount of money directly into that account. Whether or not you have profits, whether or not you declare dividend, certain amount of money has to go into that account. The reason is protect the investors, because what is a debenture? Debenture is a debt, it is a loan. At some point of time, you have to repay that loan. Now, if the amount is too big and it is a bullet repayment in the sense that you have to repay everything at once, at the time of repayment, the company may say that we don't have that kind of money with us. So, in order to avoid that possibility, what the Companies Act says is that from the time of issue till the time of redemption, put aside certain amount in that account in such a way that at the time of redemption you have enough money to repay the debentures. It is like a compulsory EMI by the company. It is like a EMI, like how you have EMI in a housing loan. It is just like a EMI to the company that every year so and so amount has to go to that account. Next is creation of charge. As I said, debentures can be secured or unsecured. Now, if the company says that I will issue secured debentures, and generally most of the debentures are secured debentures. It's very rare to find unsecured debentures for the simple reason that any debenture which is unsecured is treated as a public deposit. Now, that is not to say that you cannot issue unsecured debentures. You can, of course, issue unsecured debentures. Nothing stops you. You still have to follow these guidelines. Okay, you still may have to list those debentures, but in addition to complying with these guidelines, you also have to comply with the public deposit rules because it will be treated as a public deposit. So whatever Companies Act rules regarding public deposit are there, you have to comply with that also. So most of the companies, they create some sort of security. And secondly, when you issue a debenture, the debenture holders will also want some security. At least Indian debenture holders very rarely will they accept a unsecured debentures unless you are a Tata or a Birla company and they know that you are not going to default. So, if the issuer proposes to create a charge of security on its assets in respect of secured convertible debentures, it is required to ensure that assets are sufficient to discharge the principal amount, they are free from encumbrance, where security is already created on such assets in favor of banks or financial institutions. The consent of the bank is obtained for the creation of a second charge. Security cover is required to be arrived at after reduction of liabilities, having a first prior charge. However, creation of fresh security and execution of fresh trust is not mandatory if existing trust deed provides for continuance of security. Okay. So what it means is that if you want to create a charge on your debentures, one, you have to ensure that the assets which you are charging, they are sufficient to cover the principal amount. Those assets are not already being charged. They are free from encumbrance. Encumbrance means charge. Encumbrance means any obligation. And if those assets are already charged to a bank or to a financial institution and you want to again charge those assets, you can do that if you take the consent of the bank or that financial institution to create what is called as a pari passu charge. Pari passu means they will share in the charge. If that asset is sold, the proceeds of that assets will be shared between that bank and these debenture holders. So both of them will have equal claim or equal stake in that charge. Okay. Now this is one more requirement. As I said, debentures can be convertible or non-convertible, or they can be convertible partly, or they can be convertible fully. Now, what do you mean by convertible? Convertible means debentures are convertible into equity shares after a certain point of time. Okay. Now that conversion might be in part or full. Like to give you an example, if you issue a debenture of 100 rupees and you say it is convertible, then you have two options. So what are the options available with you? One is that entire 100 rupees will be converted into equity, which means as an investor you will not get your money back, but you will get equity shares of that similar amount. Or you can say it is partly convertible. Let's say 50 rupees you will get back, for remaining 50 you will get equity shares. So what this deals with, rollover of non-convertible portion of partly convertible debentures. So let's say you have a debenture which is partly convertible and that portion which is not convertible, so that 50 rupees which you have to repay, you can roll over that part. What is rollover? Rollover is nothing but extending the maturity, extending the time of redemption. It basically means that I don't have the money right now. I was supposed to give you that money back today, but please allow me to extend that repayment date by 6 months or 1 year or 2 year or whatever that is. You roll it over, means your debt continues. I'm still indebted to you, but I'll not pay you today. I'll pay you at some future date. Till that time, I will continue giving you interest. So what it basically means that I have the money to give you interest, but I don't have the money to give you that entire money back. Now, if a company wants to do that, if wants to roll over the debentures or roll over even a part of the debentures, it has to follow certain guidelines that are given by SEBI. What are the guidelines? If you read this, non-convertible portion of partly convertible debentures, the value of which exceeds 50 lakhs can be rolled over without change in the interest rate, subject to compliance with the following conditions. So you cannot change the interest rate, but if you want to roll over the repayment, the following is the guideline. 75% of the holders should agree to that. The issuer has, along with the notice sent to all the holders, also sent an auditor certificate on the cash flow of the issuer with comments on the liquidity position. The issuer has undertaken to redeem the non-convertible portion of the partly convertible debt instruments of all holders of the convertible debt instruments who have not agreed to the resolution. So what it means is, how to remember this? See, what are you telling the bondholders? I am not going to give your money back today. I will give it to you at a later date. So one, they have to agree. Who has to agree? 75% of the bondholders have to agree. As far as the remaining 25% who do not agree, you have to give them their money back. Anyone who does not agree, you have to give them your money back. You have to undertake that if you don't agree, I will give you your money back. But if you agree, I will extend the period. That is one condition. And the second condition is you have to give an auditor certificate about your liquidity. That the auditor should confirm what are the cash flows of the company and he should comment on the liquidity position, because that is important to the bondholders to understand whether you will be able to pay ever or you will just be keep extending it. That will also determine their decision. Okay, so these are the three conditions. Next is conversion of optionally convertible debt instruments into equity share capital. Okay, so what it means is, as I said, the classification of debentures. One classification is convertible, non-convertible. Okay, when you say convertible, it can be optional or non-optional. What means optional, non-optional? I issue a debenture to you, 100 rupees, and you have an option that after 3 years or 4 years, you can either ask your money back, or you can say no, I want to convert it into equity shares, or you can do both also. You can say I want part of my money back or part of my debentures to be converted to equity shares. It is called as optionally convertible. Okay, that option is given to the debenture holders. Okay, so what it says is no issuer can convert its optionally convertible debt instruments into equity shares unless the holders of such convertible instruments have sent their positive consent to the issuer, and this is important, non-receipt of reply to any notice sent by the issuer is not to be taken as a consent. So if I don't reply, it means I have said no. So they have to actually agree. If you give them an option, then they have to say that yes, I agree. And if they don't say anything, it means they have not agreed. Second, where the value of the convertible portion of any convertible debt instrument issued by a listed issuer exceeds 50 lakhs and issuer has not determined the conversion price of that debt instruments at the time of making the issue, the holders of such convertible debt instruments are required to be given the option of not converting the convertible portion into equity shares. So if you have issued convertible debt instruments and you are not given a conversion price, then on that date of that conversion, you have to give them an option of saying no. Okay. And second, where an option is to be given to the holders of the convertible debt instruments in terms of para 2, and if one of the holders do not exercise the option to convert instruments into equity share capital, he is required to redeem it. So if they say no, then you have to give them their money back. And this is securitized debt instrument regulation. I will first explain to you what is securitization, then probably you will understand this. We'll go to the remaining conditions prescribed by SEBI. Again, it says appointment of intermediaries. It shall enter into arrangement with the depository. It should appoint merchant bankers. Okay, it has to appoint debenture trustees, as I have said earlier. Then, just like a public issue, you have to give a offer document. The SEBI says that the offer document should not omit. So, offer document means it's just like a prospectus that you issue. So, there should not have any disclosures. It should not omit disclosures of any material fact. Okay, and it should not contain any false, misleading statement which can mislead the investors. Minimum subscription, as I said, for public issue of debt security is 75% of the base issue size. If the issuer does not receive minimum subscription, then the entire application money shall be refunded within 12 days. In the event there is a delay, he has to pay an interest of 15% per annum for the delayed repayment. Mandatory listing, when I say mandatory listing, it says the company desirous of making an offer of debt securities to the public. So if it is a public issue of debt, then yes, it has to be listed, but not all debt securities have to be listed. There are certain exemptions which are also given in the listing guidelines. So if it's a private placement of debentures, does not have to be listed. There are certain exemptions which are given, in which case you don't have to list. But if you decide to go for listing, you have to follow the stock exchange regulations for listing of these debentures, whatever the guidelines are given. You have to make an application to the stock exchange for listing in principle approval. Then you have to make an application for final approval for listing of the debentures. And then the final part of this is debenture trustee. As I said, it is compulsory to appoint a debenture trustee. You have to create a trust. The trustee will act for the benefit of the debenture holders to protect their interest. And SEBI prescribes rules, regulations as to who can be appointed as a debenture trustee. Now, there are obligations that are given. The debenture trustee shall, prior to the opening of a public issue, furnish to the SEBI a due diligence certificate. The debenture trustee shall be vested with powers for protecting interest of holders of debt securities, including right to appoint a director in consultation with the debenture holders. Third is, not everybody can become a debenture trustee. SEBI has prescribed debenture trustees regulations 1993. Any person who complies with that debentures and registers with SEBI can only be appointed as a debenture trustee. So first you have to follow those regulations. You have to register yourself with the SEBI as a debenture trustee. You get a certificate from SEBI. You are audited by SEBI regularly. There are a lot of disclosures and information that you need to give to SEBI from time to time. Only if you follow all these requirements, then you are fit to be appointed as a debenture trustee. And the debenture trustee shall supervise the implementation of conditions regarding creation of security. So is the security created within the required time? Is it enough to cover the amount of loan? Is the security fit and proper? Is it legally created? Does the company have right to create that security? Are the assets actually belonging to the company? Are they free from encumbrance? Is the stamp duty paid properly? They have to vet the title search reports if it's a immovable property. So all those due diligence they have to do. And as I said, if the issue size exceeds 50 lakh rupees, you also have to have a merchant banker. The merchant banker shall ensure, verify and confirm that disclosures made in the offer document are true or fair and adequate and the issuer is in compliance with these regulations. Person shall not employ any device, scheme or article to defraud in connection with the issuer's subscription. And main is the security created should be adequate to ensure 100% asset coverage for the debt securities. So what is securitized debt instruments? For that you will first need to understand what is securitization in the first place. Securitization is basically selling of debt. How it works is, say if there is a bank or if there is a financial institution or if even there is a company, I have given a loan to a certain individual. Okay, so let's assume that if there is a company or there is a financial institution or a bank, and that bank has given a loan to an individual. Now there are two options for that bank or that entity. One option is you wait till you get your money back. You'll get an interest, and at the end of the period you'll get your loan, hopefully. The second option is I can sell that loan to another person. What it means is, what A will do is he will contact C, another person, and tell him that look, I have given this loan to B, B is going to repay it to me, but I want to sell this loan to you. I want to assign my debt to you. You give me my money immediately, whatever is that amount of debt, and when B wants to repay it, that interest or the final loan, he will repay it to you. You will get the interest, you will get the final payment. I want my money immediately. So that is basically securitization. So you have sold your loan, you are assigned your loan in order to get your money immediately because you don't want to wait till that tenure gets over. And there is somebody who is willing to take that loan. That is called as securitization. Now, if you see, it is a process by which a company clubs its different financial assets to form a consolidated financial instruments which is issued to investors. So this is a crude explanation. Now how it works. The process enhances liquidity. It serves as a useful tool, especially for financial companies as it helps them to raise funds. It is kind of discounting of bill receivable. Bill receivable is a very good analogy. Instead of bill receivable, you say loan. What is discounting of bills? The company has a bills which is due to it and it discounts it with some third person. The same way you discount a loan, but it is a bit more complicated than that. That depends on your negotiating, how you can negotiate, whether you get a full or you get a part. So now, how does it work? It's a fancy title for selling of a pool of assets to a trust, which turns around and finances the purchase by selling securities to the market. An investor who purchases company stock has a claim to the company's assets and the future cash flows. Similarly, an investor who purchases the securitized debt has a claim against the future repayment of the underlying debt instrument. So there are four parties in a debt securitization process. First is the borrower who originally took that loan and promised to repay. Second is the loan originator. Originator means nothing who gives the loan, the lender basically. Okay, so there is a borrower and a lender. The second party, that is a lender, is able to realize immediately most or all of the value of the loan by selling it to a third party. That third party is a trust. And to answer Hakimuddin's questions, this is where the bill discounting part, the similarities with bill discounting end. Till this time, it is nothing but a bill discounting. Now, what happens is This is very interesting. The second party is able to realize most of all of the value of the loan by selling it to a third party, which is usually a trust. Now the trust takes that loan, but how is the trust going to repay that second party, that is a lender? If I take a loan from a lender, I have to give him money, but I don't have the money. How am I going to get that money? I take that loan that you have given and I issue securities to various other investors saying that, look, I have this instrument with me, please participate in this. Whenever I get the money from this instrument, I will repay you. They give you money which you give to the lender, and when they give you money, in return for that, what you give is share certificates or debenture certificates or whatever certificates that you get. So there are four parties in this. This is called as securitization. So if you follow a chain, the securitized debt product eventually sends loan repayment to the fourth party. So the borrower who has actually taken the loan, he doesn't pay to the lender, he doesn't even pay to the trust. He pays it to a fourth party to whom the trust has issued some securities for funding this whole transaction. I know it's a bit complicated, but it is a very in thing these days, securitization. This securitization is what caused the debt crisis of 2008. That massive debt crisis of 2008 was caused by securitization. Because this is a very crude example that I've given where there are only four parties. It ends at the fourth party. There the chain was for 10, 12 parties, and they were spread across not just the United States but across the world. What happens is it all works very, very well till the time somebody defaults. If somebody defaults, then all the people fall like dominoes because everyone is dependent on the other, and they are all dependent on one principal thing, that the borrower will repay. See, all this is dependent on what? All this is dependent on one simple fact, that the borrower will repay. What if the borrower says I don't repay? In a very simple transaction, what will happen is the lender will be bankrupt at the most. But in this case, you have involved 10 other parties in that transaction, all those 10 parties will be bankrupt. Okay, so that is what led to that famous subprime crisis in 2008.